Welcome back to my channel, Balance Sheets Matter. We have another subscriber request to look at the Hershey company. So we're going to be doing a stock analysis on the Hershey company, ticker HSY. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do daily stock analysis videos. So if you want to get ideas for potential stocks to buy and value drops to avoid, make sure to subscribe to my channel because that's what it's all about now, is individual stock analysis. So let's dive into the analysis, look at some of the top level things that Guru Focus. I always like to take a quick look at the Guru Focus value band here. It's saying we could be modestly undervalued. We're going to have to see if that's accurate or not when we actually dive into the financials. Next thing is the P ratio is currently sitting at 22.89, but they have a forward PE of 19.33, which is a lot better. Also, for those dividend investors, they have a current dividend yield of 2.18, a forward dividend yield of 2.42 with a payout ratio of 0.48 and a 3-year dividend growth rate of 9%. So that's pretty good on the dividend front there. So now let's bring up the 30-year financials here. So first thing we can see the overall long-term growth revenue trend here. We can basically see that they do hit flat periods, but over the long term, they are getting this consistent trend, which over the last 10 years has been about 4.5% per year, but in the shorter term, on the 5-year, it's 6.8%, and the 1 year, it's 12.3%, where EPS has been outpacing that almost on all of these fronts of above 10%, which is quite good. So let's take a look at their financials here. First thing I like to take a look at, which does apply for companies like this, is return on invested capital over weighted average cost of capital. And the Hershey company is looking really good for this. For the most part, all of the return on invested capital is over the 20% range. So that's very strong. And their weighted average cost of capital is quite low right now at only 6%. So that's really great if they want to take in any debt or they have to issue shares to do acquisitions. They're in a really good position to do that. So let's take a look at the revenue trend. You can see over the long term, the revenue has been growing, but they do hit little slow patches, but it has started re-accelerating again a little bit. I will tell you this is largely due to some acquisitions they have been doing, which we'll go over later. Basically, the gross margins are looking really good. They're just sitting under 44% right now. They're maybe at the peak of 45, 46, but in past years, they're around this 44, 45 too. So I'm not seeing really any deterioration on the gross margin. This is really good. They're able to keep their pricing power. It's a good thing basically for the Hershey company that they're not losing any competitive edge. Then we also look at their operating margin. This is to basically see if their costs of selling and general admin and other expenses are outpacing their overall revenue growth. And we're actually seeing a really good increase on the operating margin, as their operating margin is now up to 22%. And if we compare this to 5, 6, 7 years ago, it was under 20%. So they're actually getting more cost efficient as time goes on. So while you may think this company is quite mature, they actually still seem to be in that area where they're almost maintaining their competitive edge and getting more cost efficient at the same time, which is a really good sign. The next thing is to basically look at the interest expense. They have started taking on some interest expense in the last decade, something they didn't have maybe 20 years ago as much, but it's really manageable. Right now, over the last year, it's 152 million in interest expense over basically 2.44 billion in operating income. So this is well above my 1 to 10 ratio. I kind of look at for a little kind of benchmark. So this is a really good basically interest expense. Also, they do have this other income expense here, and this is typically from writing off goodwill. So there is a little bit of write-offs going along the way, which is bringing down their net income, but it's not too concerning overall. And then we can see basically net income has been growing really nicely over the years, making new highs every year. At one point, basically almost $8 billion in the last year. And the net margin, it's been growing as well, up to 16.5%. And this is in comparison to when we maybe looked 10 years ago when it was around 10%. So this is really good for the Hershey company. And we can see the EPS increasing in line as that as well. And shares outstanding, this is decreasing, not at the quickest pace, but they are buying back shares and returning to shareholders, which is a good sign. But as we went over, they do have a dividend yield, and I think they like to return more of the capital to shareholders by the dividend. Although this may be a place for improvement, is by buying back more shares. So we take a look at the balance sheet. Let's take a look at their current ratio here. Current assets basically just under 2.9 billion. And current liabilities sitting at 2.7 billion. So this is a perfectly fine current ratio. More current assets, the more current liabilities. Although for a company their size, if that wasn't the case, it wouldn't be too big of a deal either, but it is nice to see that. Overall total assets of $11.5 billion, and that is including goodwill of 2.7 billion. So we're going to have to take that out of the total equity to see what the real tangible equity is. And We also do have to consider their intangible asset, which is probably brands. There probably is some value there and everything, but that's sitting at $5 billion total, which does include that 2.7. So we have to realize of any tangible equity we see, there is a lot of these intangible assets in there as well. And then basically you can see total liabilities are only sitting at 7.8 billion, leaving total equity of 3.7 billion, which is well above that 2.7 billion basically of goodwill, with about 1 billion of tangible equity, although this is mostly intangibles, but they probably do have some real value. Overall, this is a solid balance sheet. It's not screaming that we have a whole bunch of excess equity or assets on the balance sheet, but it is in a good stable place, and we can basically see also long-term debt is only $4 billion overall. So I like their balance sheet overall. Let's take a look at the cash flow statement. One thing I like to look at basically is we look at this cash flow from depreciation and see how they've been spending on their purchase of plant, property, and equipment. A company that is growing, this number should always be a little bit higher. So if it's really out of whack, that could tell us something. But we're typically seeing this maybe just a touch higher, a lot of times in line of the cash flow from depreciation. So this is telling us basically what we are kind of seeing on the income front in regards to what was being depreciated versus what is being reinvested into basically assets in the balance sheet there is pretty much in line, so it is fairly accurate. But you can see the one big difference that has been happening compared to previous years is they have started doing a lot more basically acquisitions, and this may be a sign of where kind of the company is headed to in the future. This is something they weren't doing before, basically 2008 to 2013. If we actually went further back, you pretty much see almost no purchase of businesses, but now almost every year they're doing some acquisitions, and they are getting bigger. As you can see, basically in 2018 almost 1.4 billion, and in 2021 over 1.7 billion, and even these other years in the last 12 months 344 million. So this is kind of a transition of their business model a little bit, of that they are starting to acquire more brands. So we're really going to have to watch them to see if they are doing this well and they are providing good return to shareholders, because this is one area that sometimes companies, they get a little overzealous in these acquisitions, they make bad ones, and that can be very costly for stockholders and cause big drops in the stock price. So this is one thing that could be a good thing for the Hershey's companies, because I do like companies that do acquisitions if they do them well. But we also have to be aware, if they do start doing bad acquisitions, this could hurt shareholders and this could be a warning sign. But overall, this is just something to watch. It's not necessarily bad or good at this point. And then we can see how they've been returning capital to shareholders, repurchase of stock, but you can see that has been trending down a little bit compared to previous years, such as 2014, 2015, 2016, when they're putting over $500 million a year into the repurchase of stock. In the last couple of years, they've been doing under that, and that may be because they're spending more money basically buying these different businesses and these new acquisitions. So this is why I say that it's really important to see if those acquisitions keep turning out well and they are doing good ones. It'll be a very key thing for Hershey going on in the future. And the cash flow from dividends, you can see it's been increasing every year. That's great. They got a manageable payout ratio. They can easily afford this. You see their free cash flow. It's a very easily affordable dividend. So I wouldn't expect any dividend cuts, and looking good basically going forward in the future. And as we already know, basically the forward dividend is higher than the current dividend. Now let's take a look at the contractive chart to potentially get a little idea of their relative valuation, which I always like to do. First of all, basically let's pop up the revenue with estimates. So you can see they are expected to continue growing revenue nicely in the future. Not at a fast pace. It's probably at their more historical pace around this 4 or 5%, but that's not a bad thing. And let's also look at basically the EPS with estimate, because that's what really matters, is the earnings they're delivering. And that looks to be going pretty good as well, basically increasing EPS going forward as well. So now let's pop up the price to sales ratio, see what that's looking like. And we can see this has been expanding up over time. Let's just shorten this chart a little bit. 30 years, get a little bit more accurate data there. And some might say, oh, this is looking a little bit expensive, but we have to really see if that is the truth by comparing this to the net margin, because as we went over, the net margins have been growing, and that would justify a higher price to sales ratio as well. So we basically pop up the net margin. I'm going to get rid of the price just so we can see it's a little bit clearer. And you can see basically before, maybe on the high side, it was around 12%, and on the low side, it was around 5%, with maybe an average net margin of 8 or 9 for this longest time, from the 1990s to about 2017. But then basically since 2019, it's boosted up to around 15%. So this will justify a higher price to sales ratio going forward. This is also dependent on if they actually maintain this higher price to sales ratio. And again, we'll have to see if that happens, but it looks like it has been maintaining it. From everything else I looked at, it looks like it should maintain as well. So let's take that off. And then the price to sales ratio now, when we put this in context of basically these last several years justifying a higher price to sales ratio, this potentially could be an attractive price to sales ratio here. But we're going to look at a few other things here. Let's look at the dividend yield, because with these consistent dividend stocks, this sometimes can be the best way to tell you if it's a good price. So let's bring up the price of the stock. And again, you'll see that a lot of time, this dividend yield kind of inverses the price of the stock. So whenever your dividend yield is high, it's typically a good time to buy the stock. And right now, the dividend yield is only 2.16%, but the forward is 2.42. So that is a little bit higher if we look at the forward one, but this is saying that Hershey's could get a little bit cheaper, at least according to the dividend yield on a relative valuation in the past. So I'm going to look at the overall stock chart now, and I have drawn this pitchfork trend channel, which I think kind of combines the fundamentals and the technicals together since 2008, 2009. And you can kind of see we're kind of in the middle dropping down, but it looks like we could get lower and maybe go a little bit sideways. And again, this has been quite a dramatic drop that's been occurring. And if you kind of look at what's happened a lot of these other times, after you've had these big drops here, there's a little accumulation that can happen for quite a few months, sometimes even, over a year basically, where the stock settles down and that's your time to accumulate it. So maybe that's what's going to happen to Hershey's right now, because it's not looking like that high of a valuation, but it definitely looks like that valuation could get much more attractive if over time it were to improve the fundamentals, up that dividend yield while just going sideways in price, and have that forward dividend yield become a real dividend yield. So overall, I think Hershey's is starting to actually look like quite an interesting buy. I'm not pulling the trigger yet. I would probably be waiting for it to get a little bit cheaper, or just wait for a little bit more time to pass. But I think of the combination of those, I think it could be a great valuation to buy. Overall, the fundamentals of the company, I think, are looking pretty good. So I hope this stock analysis gave you some insights into the Hershey company. If you liked it, remember to subscribe to my channel, like the video, and I'll see you in the next stock analysis.